Are you looking to buy some ETFs, but you don't know which ones are your best choices? Well, today I'm going to go over my 4 favorite ETFs for every single Australian. And because I'm sneaky, I'm also going to give you guys a bonus 2 ETFs for the more aggressive style investors out there. And the fun doesn't end there. I'm also going to give you guys what I think is the best combinations of these different ETFs. And it's one of the hardest and most stressful parts for new investors, finding the right ETFs and then finding the right combination of ETFs to invest in. So I'm going to do all of that work for you. And by the way, once you've finished this video and you have a good idea of what combination of ETFs are going to suit you, head over to my other video, which I'll link up here and in the description as well. And that's going to tell you which is the best platform for you to buy them on. And I go over all sorts of different scenarios. I crunch all the numbers, what's going to be the best cost, the best app for exactly your needs, because that's how I roll. Last interjection from me before we get into the good stuff. I'm not a financial advisor. This is just a dude on the internet giving you his opinions on his research. Do your own due diligence. This is not financial advice. And without further ado, let's get stuck into it. So the first thing that's good to know is all of the ETFs I'm about to mention are on the ASX. They're listed in Australia. You can buy them on any of the platforms, and they all have a really strong proven history, some longer history than others, but they've all performed very well. And I think all of them have enormous future potential. So first up is VAS or VAS, and that seeks to track the Australian Stock Exchange, which is the 300 biggest public companies in Australia. So as we come over to my screen here, you can see that the fund size is $7 billion. So this is a really big Australian fund, and it's one of the most popular that we have in Australia. It's domiciled in Australia, which is excellent news. Its management fee is only 0.1%, which is extremely low. And you can buy one stock for just $86 if you were to buy them today. And as you can see here, the investment objective is to track the return of the S&P ASX 300 index. So the 300 biggest companies in Australia. Now, as we come over to the portfolio tab, we can see that they invest, like we've mentioned, in 300 stocks, the ASX 300, and they have a really nice dividend yield of about 2.75%. And it's been higher in the past, but with COVID, it's been a little bit more difficult. Now, one thing that you'll notice about VAS is it very heavily invests in the banks of Australia, with some other ones sprinkled in there, but they really like the banks. You can see over here in their holdings, they've got Commonwealth Bank, National Bank, Westpac, ANZ, they've got Macquarie Bank. You get the idea. You can look at this in your own time if you'd like. Now, next up, the most important, the performance tab. That's what we all want to know. How has it been performing? And you can see here that since inception, it's gone up 9% per year, which is really solid gains. Over the last 10 years, 7%. Over the last few years, 6.5%. Really strong gains. And that's what we want to see. The past as well as the future prospects. And if you like the chances of Australia continuing to be a successful country, then VAS is a really solid option. And a nice little bonus of VAS is that the dividends are often highly franked, which means that they've already paid the tax on your behalf for a percentage of your dividends. All right, next up is another Vanguard ETF, and that is VGS, which seeks to track the MSCI International market by investing in the biggest companies all around the globe, and this one is a beauty. Now, something interesting and fantastic about VGS is it offers enormous coverage around the globe in developed countries, including America, which it's very heavily weighted in. About 70% of its weighting is toward the US, which is the biggest market in the world, and it excludes Australia. So if you've invested in VAS, VGS gives you the rest of the world, or most of the rest of the world, the developed world, minus Australia. So that's really nice touch in one ETF. Now, as we come back over to our screen, we can see that this fund is $2.6 billion, which is still a really big fund. Again, domiciled in Australia, which is very nice. The management fee is still very low at 0.18%, and it's about $85 a stock if you wanted them today. So 1,500 holdings and dividends at 1.8% at the moment, which is also really decent. That has been much higher in the past, but as we said before, COVID brings that back down a bit, but 1.8% still very respectable. Now, as we look at the region exposure, you can see that it covers a lot of ground here. And if we go down further, we can see the actual market allocation country for country. So like I mentioned, heavily weighted in America, which is the biggest market in the world, but it also covers countries like Japan, the UK, France, Canada, Germany, Switzerland, Netherlands, Sweden, Hong Kong, and the list seriously goes on and on. You're covering a hell of a lot of the world. And just check out these major holdings. You've got Apple, Microsoft, Amazon, Facebook, Tesla, all these massive companies that we know so well. You get that in one stock. Now for the good stuff, the performance, the total returns, and since inception for VGS, they've gone at 12% gains per year, which is fantastic. 11% over the last 5 years. The last 1 year alone, even during COVID, has been almost 6%. It's about as good as you can ask. This is a really solid fund. All right, next up is our last Vanguard ETF, and that is VAE, which seeks to track the FTSE Asia ex Japan market. That is one hell of a mouthful. So like I said, in this video, I want to cover all bases. That's why we've gone over Australia, the international markets, and now the Asian international markets as well, including emerging markets. So we can see that we've covered a hell of a lot of ground in just 3 stocks so far, and there's more to come. All right, so if we look at VAE, we can see that it's $280 million fund, which is still pretty big, but nowhere near as big as the other ones. It's definitely on the smaller side of the scale, as it's a fairly new option. Again, domiciled in Australia, which is what we want to see. Management fee only 0.4%, which is higher than the other ones, but still pretty respectable. And each stock is $83 at the moment. Now, as we come over to the portfolio tab, you can see once again, this follows 1,400 different stocks. This is a really big portfolio, and the dividends are 2%, which is again still very, very respectable, especially considering the year we've just had. Now, as you come down the page, you can see the region exposure, and it's quite heavily weighted in emerging markets, which explains why it's a slightly higher cost. The management fees, 0.4%, because these are slightly riskier and also less backed. So it's a slightly riskier portfolio, but still a really solid option. As for the market allocation, you can see it's heavily weighted in China, 42% of the portfolio, but also very heavily weighted in Korea, Taiwan, and India, as well as Hong Kong, Singapore, Thailand, and you get the point. We're investing in most of Asia. Now, as you come down the page a bit more, you can see the actual holdings. So 6% is in Taiwan Semiconductors, 6% in Tencent Holdings, you get the point, Alibaba, Samsung. And just something to note is the percentage of assets actually changes. If you look over to the right, you can see how much of the portfolio is weighted in one particular or each particular stock, and that changes all the time. So don't get too bogged down in it, but it does show you what they're investing in at the moment. All right, next up is my 4th suggestion, which is the last one of the main suggestions before we look at the bonus ones, which are for higher growth, more aggressive style investing. So the 4th option is IVV, which seeks to track the S&P 500, or the 500 biggest publicly listed companies in America. Now, if you followed this channel before, you'll know that I've mentioned many times that Warren Buffett, one of the most famous investors and most successful investors of all time, always talks about the average American being best off putting their money in an index fund that tracks the S&P 500, and for Australians, that would be IVV. And as you can see from my screen here, that this is actually a BlackRock ETF, which is similar to Vanguard's, just another company, and it's actually one of the biggest in Australia. It's an enormous company. It's one of the biggest in the world. So as you can see for IVV, it's trading at $496 today. The management fee is a freakishly low 0.04%, which is the lowest of any we've talked about so far today. As you can see, over the last 10 years, this fund has returned 17% per year. Over the last 5 years, it's been 13%, 3 years has been 14%, and what more could you possibly ask? That is about as good a numbers as you could hope for a safe, solid investment. And again, it's domiciled in Australia, which is always nice to look out for. Now, something I want to point out to you is that if you have VGS already, or you plan to invest in VGS, there's quite a lot of overlap with IVV, because both of them heavily focus on the American market. Although VGS does also focus on the international market, it's still heavily weighted towards America. So there is a bit of overlap, something very important to take note of. But don't forget, I'm going to go over my favorite combinations in just a couple minutes. And that brings us to the bonus 2 ETFs for the more aggressive investors. These are more volatile, which means they tend to fluctuate more than the ones I've mentioned before, but they also have really high performance and can grow at incredibly rapid rates, which is what they've done over the last 5, 10, and even 20 years. Now, before I get into them, something to note is because they are so volatile and they're higher risk, it could be a smarter idea to invest a smaller portion of your portfolio into them. Even though they have amazing growth, they are the most volatile. So generally, I would say it's smartest to put most of your money in safer, more solid, less volatile funds, and then a smaller percentage into some more aggressive stuff to get that extra growth. So the first bonus ETF we're going to look at is NDQ, which seeks to track the NASDAQ 100 index. And as you can see here, it says that this comprises of 100 of the largest non-financial companies listed in the NASDAQ market, and includes many of the companies that are at the forefront of the new economy. And as we come down the page, you can see without a shadow of the doubt, it is investing in the biggest companies that we all know and love, Apple, Microsoft, Amazon, Tesla, Facebook, Google, Nvidia, all of these massive companies that have performed so well over the last 5, 10, and 20 years. And that's why it's had so much growth over that period. Now, it's important to understand that just because it's had an amazing last 5, 10, 20 years, that doesn't mean that's going to continue forever. But as long as you think that those big companies are going to continue to dominate the landscape, then this is a really good and really viable option for you for super high aggressive growth. And the second bonus ETF is Asia, which is probably the most exciting of the entire batch because it has performed the best by far this year alone at 60% growth this year. Now, as you can see here, the fund objective of Asia is to track the performance of an index comprising of the 50 largest technology and online retail stocks in Asia, excluding Japan. And if you have a look here at the portfolio holdings, it's heavily weighted in Samsung, Taiwan Semiconductor Manufacturing, Meituan, don't really know how to pronounce that, sorry, Tencent Holdings, Alibaba, JD, all these massive Asian tech stocks, which have dominated Asia for a really, really long time, and that's why it's shown such incredible growth in recent times. Now for the most important part of this video, other than the fact that you needed to know which ETFs I think are best, I want to give you what combinations I think are the best and the most suitable to your needs. And just as a reminder, if you want to get aggressive, then you can add any of the two bonus ETFs, Asia and NDQ, to these combinations, but I'm not going to mention them for the combinations. That's totally up to you. The combinations are just going to be the main four that we looked at earlier. All right, if you want a cookie cutter clean, very well diversified, solid, well-performing portfolio, then I like VAS, VGS, and VAE, which covers almost the entire world, including emerging markets. A really good, well-diversified spread. With just those three funds alone, you get exposure to the Australian market, the American market, as well as the international market, the Asian market, including the emerging markets. That is just an enormous spread. 3 funds, cannot go wrong. And another way you can go, a different combination, is VAS, IVV, and VAE. And that's going to give you exposure to the Australian market, the S&P 500 in America, the American market, as well as the Asian and emerging markets. Another really good coverage. The thing you're leaving out here is a portion of the international markets from developed countries like Japan and Europe and the UK and all sorts of different countries across the world. So this one has a bit less exposure. It's more focused on Australia, America, and Asia with emerging markets. So that does it for this video, guys. Let me know what you think. Leave a thumbs up if you enjoyed this video, and also let me know down below, which of these ETFs do you hold and which ones do you like the look of? Which ones do you plan to hold? Hit the thumbs up button if you enjoyed, subscribe if you want to see more from me, and I'll catch you next time. See ya!